Hello everyone, and welcome to QANTM Valuations FAST30 webinar. Our goal is to share clear, practical ways to use IP and other intangible assets to lift deal value, support growth, and strengthen governance. For those of you new to QV, we're a specialist firm that helps companies articulate and defend the value of their intangibles for transactions, governance, and tax. A quick housekeeping note. Today's session is being recorded. We will share the replay link and the slides with all the registrants after the webinar. Please post questions in the Q&A panel as we go. Today's topic is Amplifying Deal Value Through IP, presented by Tim Heberden with insights from Gerard Delaney. Gerard is the current Managing Director of QANTM IP and is experienced in negotiating deals from both buy and sell side perspectives. Tim is a world-renowned specialist in valuing intangible assets with previous experience including as a senior partner at Deloitte and author of the International Valuation Guidelines on IP and intangible asset valuation. We will take a few questions at the end. Gerard and Tim, over to you.
Hello, everybody. I'm Gerard Delaney. As Jack said, I am the Managing Director of the QANTM IP Group, and the valuations team is part of that company. In terms of my own background, very briefly, I've been involved in many M&As involving the IP business, both as a buyer and as a seller, but also with large MNCs. I worked with Ericsson, one of the largest IP holders in the world, and also with smaller companies. So I have a really good insight about the value of IP in M&A. I think, first of all, just to say, from a corporate and private equity perspective, intangible assets are an intrinsic element of value. They're not always valued correctly. Intellectual property assets are particularly important, and what Tim is going to talk about is the benefit of valuing correctly. But one question I often get asked is, why do investors like IP? And the reason is the IP stock in the world, it continues to grow. The current growth rate is about 7% per year of total IP assets in the world. That's expected to accelerate to 8% per year. And one of the reasons investors like IP is because R&D is a leading reliable indicator about future IP. R&D today, as you all know, becomes IP tomorrow. There are currently 35 million IP assets in force in the world. As I've already said, the global IP asset stock, it's growing, and there's a big shift towards APAC. If we include China, 68% of all new IP comes from Asia. So that's the sort of background as to why investors pay attention to IP in deal making. And in terms of the valuation, particularly of intellectual property assets, we see from our clients around the world, including IP holders and potential acquirers of IP holders, there is increased demand for precise valuation, which the team will talk about. It's important for licensing, particularly in the TMT space, where there's a lot of licensing activity. It's also on a practical level important for tax reporting. Increasingly, it is a commercial due diligence requirement. When people look at firms, whether it's an MNC doing fundraising, a smaller firm merging with another, a firm taking on venture capital or PE investment, an inherent part of the commercial due diligence process is the valuation of the IP. So IP valuation can be used for liquidity, for raising cash, for licensing, particularly in the TMT, but also in other spaces, for M&A activity, and for listing, and also for exit. When people come to exit their business, one of their most valuable assets is often IP. I've been in that situation myself. I worked with the company that invented mobile video. I've also worked with the company that invented SMS. And in all cases, the value of our IP was really important for successful fundraising, so we could continue to grow our business. But enough about that now. I'm going to hand over to Tim to talk about how to go about it. Thank you.
Thanks, Gerard. Hi, everyone. Well, over the last few decades, the global value of intangible assets has grown tenfold. In the regions listed on the slide, it totals $66 trillion. And this isn't just restricted to the traditionally IP-rich industries like life sciences and TMT. In the digital era, every successful business is a tech business, a data business, and a brand business. What differs is the relative importance and momentum of different categories of intangible assets and the integrated contribution of intangibles. This is confirmed by recent research by QANTM Valuations, which shows a percentage of enterprise value generated by intangibles as opposed to monetary and physical assets. Let's have a look at the profile of the ASX and 4 other industries. Firstly, net tangible assets only generate 35% of the enterprise value of the ASX 200, and this dwindles to 3% in life sciences. Balance sheet intangibles, these are mainly acquired rather than homegrown, represents a fairly modest slice, 13% of the market as a whole, and creeping up to about a quarter in food and beverage and life sciences. This leaves between 53 and 78% of enterprise value unreported, unexplained. So only 14% of total intangible value appears in balance sheets. So that's a $57 trillion blind spot. It's a pretty scary number, and it should be just as scary at an individual company level. The onus is on sellers and fundraisers to add the missing pieces of the puzzle to bridge this value gap between their balance sheet and intrinsic value. Unfortunately, the sell side typically makes a fairly poor job of identifying their full asset base, showing all of the pieces of the puzzle and articulating the quality and value of each one of these pieces. And for growth companies, a rear view mirror perspective of financial performance doesn't give a useful forward-looking outlook, particularly when there aren't any historic earnings. Investors need a bridge to the future, a coherently explained map of how the asset base will generate demand, how it will improve operating efficiency and mitigate risk. And even when there is a solid financial, legal, and technical due diligence, this tends to be siloed. So questions remain. Yes, you have some registered IP. Yes, you have a software platform. Crikey, you're expecting a lot of growth. Is your platform that good? Does the IP protect the important bits? Can you protect it from copycats, or will a chunk of future revenue accrue to someone else? So let's get to the main attraction. I think the theory is often of secondary importance to how it plays out in actual practice. Here's some added color to the background of our first case study. The founders of this fintech had overcome the initial phase of sleepless nights and cash flow obsession. Although they'd achieved a few years of revenue growth, another round of funding was required to expand market presence, to turbocharge growth, more sleepless nights. So a corporate approach to buy a majority stake was welcomed, and their M&A advisor recommended a revenue multiple approaching the sector's upper quartile. And yes, this was a few years ago. The multiples are not quite so high today. So the offer was welcome, but as proud parents of intangibles, the founders thought the beholder was not seeing the full beauty of their creation. So they commissioned a specialist evaluation of their company's intangible assets and its enterprise value. That's obviously an action that we commend. So phase one of the project was discovery. It sounds pretty easy, I'm sure you're thinking. But unfortunately, many otherwise well-run companies don't have much of a clue about what intangibles they've got, where these assets are, what they really do. I think to avoid discomfort, I'll move away from the parental analogy to that of an iceberg, which is an apt description of corporate intangibles. We've already found out most of them aren't on balance sheet. They're also lurking below the surface, lurking outside of KPIs, board reports, and traditional asset management systems. So in the case of this fintech, project identified intangibles with specificity. Not just saying that they identified a tech platform and a data platform, which happen to be the core assets of this business. It's saying exactly what rights these consisted of. We identified who owned them, exactly where they were, how the components of the platform worked. We carefully mapped how these cogs help drive the fintech's cash generating mechanism. This mapping process involved interviews with tech heads, with operations people, with marketers, and with financial analysts. And it was balanced by searches of financial and other databases to find appropriate benchmarks. We gathered evidence of what happened when the tech platform was down, what was the dip in performance, evidence about the efficiency uplift relative to competitors. And all of that was incorporated into the valuation analysis and the valuation report. So let's just give a little more thought to the valuation report. I know you're keen to get to the end to hear whether the story had a happy ending. But let me just illustrate the logic flow of the valuation. In addition to the steps already mentioned, this mapping and asset evaluation process involved kicking the tires of the tech and data platforms, trying to make the intangible more tangible to the reader. So it's not just number crunching. This phase also included an assessment of the legal and technical characteristics of the tech and data assets. And keep in mind this image of cogs in a cash generating mechanism. The valuation report explained how each cog drives revenue, margin, capital efficiency, and risk mitigation. And then the number crunching, connecting these insights to valuation assumptions and using them as sense checks of the ultimate valuation. The result? A doubling of the multiple relative to the starting position. A happy ending. And this was resulted from improved visibility of the asset quality and support for the value drivers, finding the missing pieces of the jigsaw puzzle and providing that bridge to future earnings. It's worth exploring, and I'll do this in generic terms, the value gap that often arises on opinions of the value of early stage companies. Firstly, the binary live or die possibility. And I agree that a pessimistic starting point is justified. After all, there are more dogs than blockbusters. But remember, the quality of intangible assets is essential to an informed view of the probability of success at each stage gate, at each inflection point, on the likelihood of reaching the market. And then what's the shape of the curve? Once launched, intangible assets can provide the difference between routine earnings and super profits. I have to say it, the obsession of valuers and transfer pricing economists with interquartile ranges is frankly dangerous. What about the long tail? What about the blockbuster? Why ignore outliers? That's the whole point of inventiveness and intellectual property, to stand out from the crowd. So probably worth going back to lesson 1 of IP economics. These assets exhibit nonlinear returns on investment. They can be bad as well as good. Bad for the long tail, excellent for the blockbusters. IP assets are also scalable. You don't have to queue up to use them one at a time. And they can enjoy monopoly rights. But without solid IP, there's the copycat risk. High risk of the cat or someone else eating your lunch. I won't dwell on this for too long, but I think it might be helpful to show you a framework that we use to assess technology assets, and we have similar frameworks for data and brand assets. In this illustration, the graded technology shown in orange has fantastic functional performance and financial performance and operates in an attractive market. But, oh dear, it's fairly easy to replicate due to only having moderate IP protection and access controls. But look out for the cat. There's little remaining technical risk and some remaining commercialization barriers. And that leads to that particular rating. In contrast, the benchmark asset shown in gray on the left-hand side has kind of more moderate functional and financial benefits, but it's tough to replicate and has a very low risk profile. Now, building those into the overall rating, each of the attributes is supported by a range of submeasures and informed by multiple information sources. And that resulting grading, the double B in this instance, is the result of weightings and cross-checked calibrations. Anyway, let's move on to another case study, which will involve a different maturity of company and type of assets. So this particular client was a mature listed company, which had gradually evolved from a manufacturer to becoming a brand owner. Now, the corporate name didn't match any of the product brands, and investors only had a hazy understanding of the brand portfolio, perceiving it to consist of steady rather than growth brands. As a result, the share price was languishing. And when a takeover offer arrived, only marginally higher than the market cap, some perceived it to be decent value. Once again, a smart decision was made. Although the clock was ticking, a specialist valuer of intangible assets was appointed. We soon established that not long before this offer was made, a key brand had been repositioned following the launch of a new product range, which had been really well received by consumers. And that the distribution channels had been expanded considerably in the previous year. But none of this had been effectively understood or even communicated to the market. Now, although we are looking at different asset categories and different stage of business maturity, the flow of this valuation report is not dissimilar to the fintech, the same linkages between points in the value chain. The value mapping process identified the intangible cogs. Then we kicked the tires of the biggest cogs. In this case, primarily the brands, but also product IP and contracts, distribution agreements. This is another rant coming on, but it always strikes me as weird how little interest most financial people have in the sources of revenue. It's typically a single line in a P&L or valuation model. Where the hell does it come from? What's going to make it happen? So being a brand-centric company, we had access to good quantitative consumer research, and we're able to analyze brand equity, the trends over recent times, and the relationship between brand equity and changes in volume and margin. And once again, these linkages, this equation was articulated in a coherent storyboard, being the valuation report, which provided an opinion on the intrinsic equity value together with the value of those key intangible assets. And this turned out to be a lot higher than the offer price. And once again, a happy ending. A revised offer was made 50% higher than the initial offer, and this was accepted. So once again, better asset visibility leading to a high uptick in the appreciation of value. We're, as a team, QANTM Valuations, we're kind of bursting with other case studies gained over the last quarter of a century or more that will be true to the FAST30 promise that Jack made at the outset. And I'll just summarize some of the other applications. Applications that need to shine a light on intangibles and also some of the trends that we're seeing. I suppose the first point to make is that those transactions that need better visibility of intangibles cover all transaction types, and we find the demand and the benefits come in at different phases of the transaction cycle. So whether it's pre-deal, whether it's exit, whether it's integration after the deal. And in particular, we're finding that there's growing demand for intangible-driven business valuations to support fundraising for early-stage companies. That's why it's shown in orange. And it's not surprising when you consider that the only thing in the can tends to be tangible. So when investors pick up that can and have a look at the label, curious about what's stated on the label. And they're curious as to whether they can trust those claims. They really need to understand the building blocks of value so they can decide whether the asking price is based on hope or whether it's a realistic estimate of intrinsic value. And perhaps one other application that I'll call out is joint ventures, because it often doesn't come to mind. But we increasingly find in joint ventures, in addition to contribution of tangible assets, there's a contribution of intangibles and ultimately cash, sort of balancing things up if it's a 50-50 joint venture. But quite often there's uncertainty about the relative value of those intangibles. And again, there we have the weighing scale, I guess, to make sure that the intangibles get their fair share of recognition in planning the joint venture. In terms of asset categories, so tech and brand had always been dominant, but they're really now joined by data right at the top of the queue. And of course, contractual value can be significant. But what we do find really interesting often is through the value mapping, identifying the evolution in the strength of values over time. So it might be that the tech asset is the cornerstone asset, cog that starts the machine working. But over time, the strength of customer relationships, the data asset, the brand asset might come to dominate, or might be essential that they strengthen in order for the business plan to be achieved. But that's I think that's enough of that overview. And Gerard, this seems like a good time for a change of voice. So I'll hand back to you.
Thank you very much, Tim. In closing, a couple of remarks in closing. Firstly, I hope that we have illustrated today that intangible assets are value drivers in all industries. IP is an important intangible asset. We very much want to work with you on that. It's a growing asset class that requires precise valuation. And that valuation, as Tim has illustrated, leads to better outcomes. And it can be used, as we've said, for liquidity, licensing, M&A, listing and exit. And I have been on both sides of deals in many different scenarios where I've seen that value truly come to life. So my final thoughts would be, firstly, QANTM Valuations is uniquely positioned to serve this need. And when we present to you today, we speak from many years of accumulated experience and expertise, and dare I say passion for this space. So please tap into that expertise, and we look forward to working with all of you in the future. Thank you very much. And I think I'm back to Jack now for Q&A. I hope I am.
Thank you, Gerard, and thank you, Tim. We have time for questions. Please add them in the Q&A panel now, and I will group themes as they come in. In the meantime, perhaps I'll kick off with a quick question. So it strikes me that improving visibility of assets, so that's linking quality of assets to cash flow, pricing, and risk, justifies higher multiples. Tim, I guess it's being said that financial modeling is not valuation. What's your view on that? And what differentiates a valuation by a specialist IP valuer from internal modeling?
Jack, I would say the first thing is, before we even get onto the financial modeling, is that asset assessment. So the number crunching and the forecasts on their own, it's hard to really work out whether they're sensible or not. Then when we get into the financial modeling, I guess the really crucial thing is the assumptions that are driving it. How confident are we that that next dollar of sales, that next customer acquisition, that price premium, that greater stickiness, that is justified? Why is it there? Why is it to be believed? And it's that kind of link, I suppose, of the market conditions, of the actual mechanism, the actual kind of movements in the numbers, which is so important. So yes, all of those have to be fed into a financial forecast, but it's the understanding, the rigor of the assessment of those forecasts, and then ultimately the judgment on the risk associated with the forecasts that differentiates a valuation opinion from the financial forecasts. And, again, firstly, it's justifying those assumptions, but there is obviously the credibility associated with the individual in the firm making those assumptions. So Darren refers to valuation as a craft rather than an art or a science. And I think that's very, very true. And that's why kind of human involvement is really important.
Thank you, Tim. We have some questions from the audience. So Mohammed Hikmet asks, can your company offer the valuation of intangible assets?
Yes, that's what we love to do, and it's what we do kind of just about 24/7.
Fantastic. Thank you, Tim. David Christmas. asks, when preparing IMs, how do you think the best way to display the value of your intangible assets is without diluting the overall messaging?
It's a bit of a two-way journey here, David. So, that identification of the intangibles and doing the valuation and really understanding the importance of the different intangibles helps you then go back and make sure that you've given enough of a description on the important intangibles and how they operate together. So I don't think that dilutes in any way. It gets back to the coherence, I think, where there's the understanding of the business model, there's shining the light on those cogs in the business model, and then explaining how those result in the forecast cash flows, and to the extent that someone's expressing an opinion on a value, how that all links through into the assumptions and findings.
It seems to me that perhaps that'll help strengthen the narration in the IM for linking value to financial outcomes.
Quite right.
Thank you, Tim. We have another question from Umesh, and that is, would or can quantum valuations be involved in post-valuation in defending/justifying the valuation reached for, say, a startup company to, say, potential serious investors?
Yes, it can. We challenge existing valuations. We give opinions on existing valuations. Obviously, where we're involved after a valuation has been prepared, we might have less initial confidence, I suppose, in that in the mechanics and the assumptions. But if those can be well supported, we will do that, and it's certainly something that we have done. And similarly, we're talking about the M&A focus, but we do valuations for litigation and a whole lot of dispute purposes as well.
Fantastic. Thank you, Tim. And this perhaps is a good moment to explain some of your background experience in doing valuations for regulatory work for courts. Is there any stories you're able to share with the audience here?
I guess plenty of stories, but it's really useful, experience when you're doing valuation in other instances, because knowing that you're going to be cross-examined, knowing that you'll be sitting in the dock and whoever's cross-examining you will be able to refer to any page in your valuation report, any cell in your model, any leap of faith, anything that hasn't been well justified, kind of really concentrates the mind. And we try and bring that approach into any piece of work that we do. So it's not a mechanical action. Any monkey can throw numbers into a DCF model and stick the output in a report. But knowing that a switched on team is going to be interrogating you, I think is a useful learning experience.
Thank you, Tim. We have a number of questions coming through, which is fantastic to see. The next question is from Biljana Smith. Would you consider your valuation outcome to represent current market value or a key strategic tool, gaining visibility of strategic value and opportunity, ? Or both?
Biljana, it depends really on the purpose and scope of the valuation. So, right up front, we'll work out in scoping the valuation, are we looking at the market value, the fair market value? And that might be the premise, and all of our assumption and findings will look at that. In other instances, we might start off by looking at the value of an asset or a business under current ownership, and that might actually vary from the highest and best use or the owner to a particular investor. And, quite often one will have those scenario valuations saying, yes, you're generating 100 from this asset, but others could generate 150, which would, typically lead to find one of them and sell it. But also your question about strategic value, quite often scenario valuations are really insightful for management. And that's pretty much saying if we're managing this asset or this business unit or whatever it is on the current basis, what are the future cash flows? What is the risk? What is the value? And then identifying alternative strategies or alternative monetization options and looking at the value of those. So, we never pretend to have the crystal ball, but the relativity of those values and understanding the inputs that really result in one scenario being more valuable than the other can be very, very helpful to decision making.
Thank you, Tim. I think the next question is also related from Lauren Feeney. If looking to increase future valuations, are you able to give advice, for example, data versus tech versus revenue, and where focus should be?
Yes, we are. So if you, and I say yes, we are very quickly, but it does depend on the data available and the length of the extent of confidence we've got. So if you think back on my image of the cogs in the business model, that is really important. Not just the size of the data cog versus the tech cog versus the brand cog today, but the expanding kind of strength and quality of those assets over time. And, we'll sometimes find, well, that particular asset is quite important now, but you've turned up the volume to the max. There's another asset which has higher upside potential, is really well protected, but might need some extra capabilities, some extra investment. So once again, we can value alternative investment strategies, or it might even be that there's a missing cog in your business model, but you could in-license that or make an acquisition, which is suddenly going to be adding an extra one unit has a multiplying effect on the value.
Thank you, Tim. The next question we have from Nick Cornelides, our friend from IVSC. Does the incremental value for intangible assets come from higher earning power or lower discount rates / probabilities of failure, or a combination of both?
Sounds like sounds like an exam question. It's definitely a combination of it can be combination of all of those, but does vary on a case by case basis. But we certainly find sometimes particular intangible assets or the combination of intangible assets can be doing all of those things: higher volume, price premium, operating efficiencies through better use of data or more efficient technology, and lower risk. Traditionally, business values often put a risk premium on intangible assets, but you get back to one of the Benetton founders made the statement that I don't care if you burn down the factories overnight, as long as I've still got the trademarks and all of the brand IP. And you can get those situations where the IP is the annuity stream that's less risky than other components of a business.
Thank you. We have one final question from Umesh. What are the pros and cons, both of including the valuation of intangible assets of a startup company in its financial statements?
Well, I suppose the first thing is the restrictions. So by and large, you can't include internally generated intangibles on your balance sheet, except there are some, for instance, the actual development costs of software and so on, you can be capitalized. But brands, if they're homegrown, you just can't have them on the balance sheet. But that doesn't mean you shouldn't know the value of those assets. And that doesn't mean you shouldn't be communicating that value to potential investors. It goes back to the brand case study. The low share price up front, the low market cap, was largely a result of them not communicating value to the market, and hence the hostile bid. So there are two things. What you can put on the balance sheet is one sort of question, and the other is when it's worth knowing value and when it's worth communicating that to stakeholders.
Fantastic. Thank you so much, Tim. And that brings us to time. Before we close, we'd just like to thank everyone for joining us today. And we do have more FAST30 sessions arranged in the coming months. We have a topic on brand evaluation in particular, and another one on tax compliance. So thank you once again, Gerard and Tim, and to everyone who's joined us. We will send the replay and slides to all the registrants. If you would like to continue the conversation, follow QANTM Valuations on LinkedIn or contact us via the website. Have a great day.
Thank you very much.
Thank you.
Thank you.
Cheers.